And in recent weeks, we've learned about the depths to which some major banks have gone to manipulate the London interbank offer rate. Georgetown Business School professor James Angel joins us now for a discussion on the so-called Libor scandal. And Professor Angel, first, help us understand why the average consumer should even care about Libor manipulation.
Well, there are over $300 trillion worth of financial instruments that are tied to Libor, including perhaps your mortgage. In that a lot of floating rate mortgages reset according to a Libor rate. And
Barclays has been caught up in this Libor scandal.
Yes.
And explain what happened to them and what caused them to get a $450 million fine.
Well, in short, they were lying about their Libor. Now, the way the Libor rate is calculated, the British Bankers Association takes a survey every morning at 11 o'clock. And they ask the banks, if you were going to borrow money today, how much would you have to pay? Because Libor is meant to be a representation of what the banks have to pay to borrow money from each other. Now, there's not one Libor. There are actually Libors for 10 different currencies and 15 different maturities. So when you say Libor, you have to be more precise and say, well, are you talking about US dollar Libor for 30 days? Or are you talking about, British pound sterling Libor for 60 days? So you've got literally 150 different combinations. And no one bank borrows every combination on every day. But what the British Bankers Association does is they take a survey and they ask the banks, if you were to borrow money this morning at 11 o'clock, how much would you have to pay in these different currencies and these different maturities? Now, since the banks aren't necessarily borrowing every day, they kind of go, I think I'd have to pay 0.28% today on this currency and 0.58 on that one, and that's what they turn in. Now, then what the British Bankers Association does is, they get these numbers from up to 20 banks, and they throw out the high ones and the low ones. So they throw out the lowest 25%, they throw out the highest 25%, and they take the average of the rest to try to get a number that is really representative of what it costs the banks to borrow. Now, as it turns out, the folks at Barclays got caught lying about how much they would have to pay to borrow. And there are some fairly damning emails showing that they were trying to manipulate the rate. Some days up, some days down. So really what they've done is they've injected noise into the Libor rate.
And why would it benefit them to keep the Libor rate lower or higher? Where does Barclays benefit in this process?
Well, at any given time, they have tremendous positions in financial instruments that are tied to Libor. And sometimes they benefit from a higher Libor rate, sometimes they benefit from a lower Libor rate, depending on whether they're a borrower or a lender. So it varies from day to day. Now, the amount of the manipulation doesn't sound like a whole lot. Maybe it's only 1 or 2 what we call basis points. Now, a basis point is 1/100th of a percentage. So it's like the difference between 1.00 and 1.01. So to mortals like us, our eyes glaze over when we see those kind of numbers. But you take a 0.01% and multiply it by $10 billion, it adds up.
And in this segment of the Washington Journal today, in this final segment, we're going to go back to the standard phone lines. The Democratic line is 202-737-0001. The Republican line, 202-737-0002. The Independent line, 202-628-0205. And if you're outside the United States and you want to call in, it's 202-628-0184. Professor Angel, want to take you through a graphic that the Washington Post had on Wednesday of this week, talking about how the Libor rate is made to kind of give a visual sense for viewers. You said about 18 major banks from around the world, including the U.S. firms Bank of America, Citigroup, and J.P. Morgan, participate in setting the Libor. Every morning, those banks individually submit their figures for the interest rate at which each firm borrows money from the others. And the British Bankers Association, based in London, receives the rate, discards the highest and lowest numbers, and then averages the remaining ones. Give us a history of how this system came into place and why it's the British Bankers Association that gets to sort of run this process.
Well, it goes back to the 1980s, when floating rate financial instruments first became common. And the idea is everybody wanted a benchmark that represented, the bank's cost of funds. The bankers like it because if you have a benchmark that represents your cost of funds, you can make a floating rate loan to a business and lock in a profit. So the idea goes like this. You're a big corporation. You're an IBM or an Exxon, and you want to borrow some money. I, as a bank, I'm happy to lend it to you at Libor plus 1%. So, in other words, I will happily make this loan to you at whatever my cost of funds is, more or less, plus 1%. So I lock in a 1% profit. Now, in order to do this, you need to have a benchmark that everybody respects. So the British Bankers Association got into the act. They started compiling this, and it was a reliable, trustworthy benchmark that everybody thought, yes, this represents current market conditions. And so it gradually became the most accepted benchmark. It's widely disseminated. Everybody can observe it on a daily basis. It seemed to be calculated in a fairly reliable and trustworthy manner. And it became the benchmark for literally $300 trillion plus of financial instruments.
Chris Jones writes in on Twitter that all markets are manipulated. Reliance on open and honest marketplace is delusional. Since this Barclays scandal came up, how much has it served to sort of undermine confidence in this age-old LIBOR system?
It certainly has undermined confidence in LIBOR, and it's illustrated some of the cracks in the system. Now, this problem with LIBOR has been well known for years. It was in the front pages of the financial papers over 4 years ago. The real scandal here is why has it taken our regulators so long to do anything about it? If Barclays was misbehaving in 2007 and 2008, why is it in 2012 that we're finally seeing action?
And Congress has started to get in on this question, correct?
Correct. But unfortunately, what they'll probably do is focus on the symptom, which is the LIBOR case, and overlook the problem, which is the dysfunctional nature of our regulatory system.
One of the committees that's been holding hearings on LIBOR is the Senate Banking Committee this week. Federal Reserve Chairman Ben Bernanke went before them to talk about LIBOR and his thoughts on it for the future.
It's likely that the concerns are less now because we're no longer in the crisis period, and that, as I mentioned, was a period in which transactions at many maturities were not taking place. I would like to see additional reforms to the LIBOR process, assuming that LIBOR will continue to be a benchmark for financial contracts. Alternatively, there are a number of people looking at alternative benchmarks like repo rates or the overnight index swap rate or other types of interest rates, which have the advantage over LIBOR that they are market rates as opposed to simply reported rates.
Now, Mr. Bernanke has been criticized by some for not doing more to raise a red flag about this issue when he knew about the LIBOR rates being manipulated back in 2008 and 2009, correct?
Correct. Although it's easy to come in with a late hit and say, oh, you should have done this back then. But when the world was falling apart in 2008, I think you can say he thought he had bigger fish to fry.
Let's take a few phone calls on this LIBOR issue. Pat's waiting on the Republican line from Waukegan, New Jersey. Good morning, Pat.
Yes, good morning. Can you tell me, does this have, and I'll take my answer offline, but exactly what on a day-to-day basis? I mean, is this my credit cards affected? You mentioned mortgage. Is it my margin account that might be affected? Is it everything?
Well, it's for you personally, if you have a floating rate mortgage, there's a really good chance it's tied to the LIBOR rate. Now, it remains to be seen what the extent of the manipulation was in terms of, sometimes the banks were, manipulating up, sometimes they were manipulating down. So it's not clear at this point whether you are paying too much or too little on your floating rate mortgage. That's the big thing. Indirectly, it affects you because a lot of the floating rate loans that companies use to fund their operations are also tied to LIBOR. So when you buy things, you buy things from companies and they've had to come up with the money from somewhere to pay for their operations, and that also is tied to LIBOR. So with over $300 trillion of instruments tied to LIBOR, all of us are affected either directly or indirectly by this.
Another question on Twitter by Scott King on this idea of what exactly is the LIBOR and what it affects. He asks, doesn't LIBOR rates affect the ability for small businesses to get loans more than the Dodd-Frank Act as stated by the GOP?
So what's going on with the scandal is that there's noise in the LIBOR rates. That it's been manipulated up, it's been manipulated down, by amounts that seem somewhat small to a distance, but are big in the scale of the overall economy, or big to individual institutions. So, now, Dodd-Frankenstein is a monster bill with so many provisions, some of them good, some of them bad, some of them not very well thought out at all. And we could get into a long debate on Dodd-Frank, but there's some very troublesome parts of that bill, some very good things in it, and but the focus today is on LIBOR.
And we could talk about that too if callers want to ask. Today, of course, is the second anniversary of the signing of Dodd-Frank. We'll go to Jared from Marionette, Wisconsin this morning on the Democratic line. Jared, you're on with Professor Angel.
Hey, thank you for taking my call. Whether we're talking about LIBOR or mortgage-backed securities or other derivatives, it's curious that any regulation that is passed regarding the financial institutions does not include criminal penalties. It's always financial penalties. Barclays paid, I think, $450 million. These costs always get passed on to the shareholders in the form of lower stock price or consumers as higher rates for loans. If they were to attach criminal penalties to specific people, you'd see the financial industry clean up its act overnight. Until there's real jail time and real criminal penalties, this will never change.
Professor Angel, is there any push for that right now? We've had plenty of pushes for that. For example, in the Sarbanes-Oxley bill, corporations are now, or I should say the chief executive officers, are now criminally liable for misstatements on their financial reports. Now, fraud has always been a criminal offense, and after the savings and loan meltdown, hundreds of people went to jail. And we already have laws that make many of these crimes criminal offenses where people can go to jail. The question is, why haven't people gone to jail? Years after the financial meltdown, where are the indictments? Where are the prosecutions?
Arlington, Virginia, Rohan's waiting on the independent line this morning. Rohan, you're on with Professor Angel.
Yes, first thank you, C-SPAN, for taking my call. I've been listening since about 9:10 this morning Eastern Time. Wasn't sure if you've discussed yet and I did hear the question from the caller from New Jersey, Pat, about mortgages and so forth, but I'm more interested in where in the consumer borrowing sector one is likely to see the impact of this. I mean, like when I look at my credit card, for instance, there's usually so many points above prime or a certain index and, other borrowing. So where specifically would just ordinary retail borrowers likely see the impact of this? And I'll hang up and go back to listening.
Well, as I said, you probably wouldn't notice it big time. And as you point out, your typical U.S. credit card is tied to the prime rate in the United States, not to the LIBOR. And indeed, the size of the manipulations we're talking about here are, in the last couple of decimal points on the interest rates. So, it may, if it does affect you directly, it would probably be a fairly small amount. But when you take a small amount of money times a large number of customers or a very large bank position, it adds up.
And want to point out that Barclays may not be the only bank that is being affected by this. This is CNN Money headline from July 19th. Barclays, the biggest LIBOR liar? No, that may have been Citi. The article goes on to say that in early 2010, two economic professors from UCLA and the University of Minnesota looked at LIBOR manipulation and found that, at least according to one measure, Citi had misstated its lending rate by more than any other large U.S. bank in the run-up to the financial crisis. Worldwide, the bank that had the largest spread between what its LIBOR rate should have been and what was reported, according to the analysis, was the Royal Bank of Canada. The professors compared LIBOR submissions to another harder-to-fake bank rate and found that, on average, Citi understated its borrow costs by an average of 0.12 percentage points from August 2007 to August 2008. That may not sound like much, but it's 50% more than the 0.08 percentage points that Barclays underreporting its own borrowing cost, according to the professor's analysis. So how much is this scandal going to spread, do you think, to other banks?
Oh, I think it's going to spread to all of the banks that are reporting to the British Bankers Association. So it takes more than...
And as we noted before, in the United States,
right,
that's Citi, Bank of America, and JP Morgan Chase.
Right. I mean, it takes more than one to have a conspiracy. And, you know, the emails that were released, you know, indicate that, you know, these people are talking to each other. And so I would not be surprised if more banks are not... We're going to see more banks drawn into this.
And other members of the administration are already being drawn into this as well. Correct? Treasury Secretary Tim Geithner, in one of his former roles, was also being questioned by members of Congress on Capitol Hill.
Yes. Well, clearly this was an open scandal. I mean, it was on the front pages of the financial press. People knew there were problems with LIBOR, so it would be surprising if they hadn't been doing something. But I can understand, in 2008, they had other problems to worry about. Now, you'll notice that, you know, from the study you just quoted, what they were saying is, oh, these banks were saying that LIBOR was less than it should have been because they didn't want to admit how much they had to pay to borrow money. They did not want to admit that they were in financial trouble. So when they were asked, how much would it cost you to borrow money today? They said, not that much. So that way people would not know how shaky they were. That's a different kind of manipulation from the other part of the scandal, where we can see traders actually manipulating the rate in order to boost their own profitability for the day.
Just to be clear on Treasury Secretary Geithner, he was the former New York Federal Reserve, head of the New York Federal Reserve. What was his responsibility during this LIBOR manipulation period to sort of report these things or to raise the red flag about it?
Right. The New York Fed is one of our primary regulators. They're the biggest and most important bank in the Federal Reserve System. And so the president of the New York Fed actually is a very powerful government regulator because it's basically, he's the front guy in the trenches regulating those top banks.
Let's go back to the phones. Vicki is on the Republican line from Kingman, Arizona this morning. Good morning, Vicki. You're on with Professor Angel.
Hi, Professor Angel. I would like to know when this LIBOR was created and why it's so important for us to be involved with these other countries when making these interest rates and making them floating. I don't get it. I think it seems like it's just one big mess, and I do agree that these guys need to go to jail instead of paying fines, because I just think that they're ripping people off right and left. So thank you. What's your answer to that?
Well, the system goes back to the 1980s. As you may recall, back in the 60s and 70s and early 80s, inflation took off. And when inflation started going up, interest rates also started to become very volatile. And there were a lot of lenders and a lot of borrowers who really wanted whatever the current interest rate was, and so they were willing to accept a floating rate instrument. And so the question is, yes, I'm willing to lend you money, but I want you to pay me whatever today's interest rate is. Well, how do you figure out what is today's interest rate? You look for some reliable benchmark that is a measure of the current level of interest rates. And that's how the Libor system evolved, in that this large, prestigious group of banks started putting together a survey of what they were paying to borrow money. And because banks borrow money all the time, and when they make a loan, they'd love to say, okay, I'll lend you the money at whatever my cost of funds is, plus my markup. So that's a system that makes a lot of sense. And our financial system is a global system. We exist in a global economy, and we're much better off as a result of that.
So after this scandal, if the banks or different governments decide to throw out Libor because they don't trust it anymore, or if the public doesn't have any trust in it, what are the other options for figuring out this rate that is so important on a daily basis?
Well, there are plenty of other options, especially options that are based on real lending and borrowing in the financial markets. The short-term money markets are quite broad, literally trillions of dollars worth of activity going on out there. So, for example, Chairman Bernanke mentioned things like, repo rates, the rates at which, banks borrow money that's collateralized by debt. So the real question is, what instruments would you look at, and most importantly, who would calculate that number?
What do you think would be the best system to use to replace this if we were going to?
Well, clearly, I think the best system to use would be one that is based on actual borrowing by the member banks, and one that is vetted by a government agency. So either the Fed or the Bank of England should be the one that is gathering the data, and it should be based on actual borrowing. Now, there's a slight problem here. Not every bank borrows every day in every currency. So you would need to have, the rate setter or the government agency that's collecting this data, would have to have some kind of model to fill in the holes for, the areas where no banks borrowed in that currency on that day. But that's an easy technical problem. The Fed has literally hundreds of really good economists, and I'm sure that they can figure out a reasonable solution to that.
Huntsville, Alabama's next. Ned is on the Democratic line. You're on with Georgetown professor Angel.
Good morning. I would like to give a few examples here to arrive at a conclusion. If you recall, Professor Angel, in the 80s we had the savings and loan fiasco. Then in the 90s there was a British bank in Singapore where a 28-year-old employee lost $10 billion. Then later on, 2 years later, then there was a French bank who also lost a few billions. Then we all remember the 2008 bank fiasco in the U.S. Since then, since the fiasco, we had other problems. The robo-signing, the J.P. Morgan, Barclays, and now we hear about Libor. Which
so
is
Ned, what do you think the solution is to these recurring problems?
I'll tell you. Let me finish my comment here, please. In hearings, the bankers say, oh, we simply made a mistake. But this is really not a mistake. These are not mistakes. This is a culture of greed among bankers. Now, for solutions, I'm not expert in solutions for bankers, and it's very hard to control them. But I think controls and more controls may or may not, because they will outfox the controllers.
Professor Angel.
Okay, so the real question is, what do we do about this? Now, for one thing, money attracts thieves just like garbage attracts flies. And that's why we need good financial regulators. We need financial regulators who understand what they're regulating, and they need to have the resources to do it right. Now, I think debates where we talk about more versus less regulation are actually rather overly simplified, because regulation is not something that we can say, oh, let's turn the thermostat from 68 degrees to 72 degrees on regulation. I think we need to overhaul our regulatory structure. We need to rethink it, from the top down. What we need to do is say, okay, how can we come up with a regulatory structure that really works? Because we have plenty of regulation now. We have literally hundreds of financial regulatory agencies at the state and federal level, and they don't always play nicely together. One of the things that led to the recent financial crisis was the fact that we had so many regulators and things fell between the cracks. Plenty of people thought, oh, this mortgage problem, it's not in my in-basket, it's in somebody else's in-basket. And then we discovered nobody thought it was in their in-basket. So we need to really thoroughly overhaul our regulatory structure and our regulatory thinking.
Let's go to Buffalo, New York now. Ralph is on the Republican line, waiting to talk to Professor Angel.
Professor, the question I have is, maybe all our regulators and professors don't understand and haven't lived history. In the 70s, interest rates were 20 and 22%. Many companies, my own, was destroyed. And after working a lifetime and you acquire some funds, now interest rates are so low, my money can't earn any money. And I think they don't learn from the past episodes, and simplicity like that could help.
Amen, brother. During the financial meltdown, every time I heard somebody say, this is unprecedented, we're in uncharted territory, I wanted to throw my shoe at the television. Because if you looked at our recent financial crisis, it was a lot like many of the other financial crises that we've had in our financial history. So, yes, we definitely need to learn from the mistakes of the past, because otherwise, as the old saying goes, we are condemned to repeat them.
I want to read a piece of an article from the Financial Times this morning. The headline is, Libor casts shadow over swaps trader ball. On Friday, October 5th, derivatives traders from investment banks across Europe will gather at the Dorchester Hotel on London's Park Lane for the annual Swaps Ball. Traditionally, it is a night of revelry and charitable donation. The centerpiece of the evening is the post-dinner auctions that see traders bidding absurd amounts of money for an eclectic selection of luxury items, Mediterranean cruises, celebrity lunches, and VIP tickets to rock concerts. Over the years, the testosterone and alcohol-fueled bidding has helped raise £2.6 million for cancer and for sick children charities. But this year may be a little less upbeat. Over the past few weeks, more detail has emerged about the alleged antics of a band of interest rate swap traders from some of Europe's big banks following Barclays' £290 million settlement with regulators in the U.S. and U.K. over attempted manipulation of the benchmark borrowing rates. The article notes at the end that, as one former trader indicated, the group who goes to the ball is a close-knit community. The swaps ball is attended by all the traders from Paris and Frankfurt and London. But by the time this year's due at the Dorchester comes around, the slur on the industry could be even worse than it is today, hardly conducive to the usual rambunctious ball. Wanted you to give us more of a sense of kind of public outrage over the Libor scandal and sort of how is it undermining the banking system even more, or can the banking system be even more undermined in terms of consumer confidence right now?
Well, clearly it is one more black eye on an industry that has many black eyes. And but I think the real scandal is, why has it taken so long to deal with this? I mean, this is 4 years after the financial meltdown. Now, sure, I'm willing to give our regulators a pass. In the fall of 2008, they had other things to worry about. But that was 4 years ago. Why has it taken so long? I think that is the real problem. That we need a financial system, but we also need a good financial system. We need one with intelligent regulation. And again, it's not a question of more or less regulation. It's a question of more intelligent regulation. And it's a question of timely regulation. There's an old saying that justice delayed is justice denied. To come back, 4 and 5 years later, while these guys have been doing this stuff all this time, that is the scandal.
George from Richmond, Virginia is up next on the Independent line. You're on with Georgetown University School of Business Associate Professor James Angel.
Good morning, Mr. Angel. My question is, isn't this a lot similar to the mispricing of risk of the bundled subprime mortgage market and how it affected the global financial system? And that any time risk is manipulated down or up, then not only does it does it ruin confidence, but it also, you know, it's the mispricing of risk. If these derivatives, you know, that's one of my bigger things. And the other is anytime you manipulate markets, you know, it's like knowing who's going to win the horse race. You've got the upper hand.
Well, I think this is a very, very different problem than what we faced with the subprime securities. That, you know, here we're talking about people who are cheating by 1/10 of a percentage point. And yes, it's a scandal. And yes, because so many financial instruments are based on this, you know, the Libor rate, like Caesar's wife, must be above suspicion. But we are not talking about trillions of dollars of losses to the financial system here. You know, we are not talking about items that undermine the solvency of our financial structure. What we're talking about is, you know, a bunch of traders lying around the edges to try to make that day's profit look good. And yes, it is a scandal. Yes, it is a problem. Yes, we need to fix it, but it is one smaller problem compared with the trillion-dollar meltdowns that we had 4 years ago.
Still in individual rights on Twitter, Mr. Angel, would we benefit from asset-backed currency, no ability to inflate artificially set interest percentages, harming economic growth?
Well, we tried that in the 19th and early 20th century, and what it gave us was one crisis after another. So it sounds great in theory, but the problem is no government can live up to it, because what you're basically doing is putting a price control on whatever that asset is. So if it's gold or silver, what you're basically saying is the price of gold or the price of silver can never change. And when economic conditions change, for example, when you have a new gold discovery or a new production process that makes it cheaper to extract, then the price cannot adjust. Or when you have changes in the political situation and you know, you have a war or some kind of foreign crisis and everyone goes to convert their currency into that commodity all at once, you have a mess. So we learned from our experience in the 19th and 20th centuries that those kind of you know, fixed asset-backed currencies just didn't work. They seem to work for a short period of time, but then they blow up in an even worse crisis. The bottom line is, in order to have a stable currency, you have to have political and economic stability. If you don't have that, no matter what kind of system you have, you're going to have a mess.
Don from Vermilion, Ohio is next on the Democratic line. Don, you're on with Professor Angel.
Yeah, Professor Angel. Well, I have a question for the host first. What is C-SPAN private, or is it funded by the government or whatever? Could you please answer that? But for Professor
C-SPAN
Angel,
is funded by fees paid by the cable companies as a public service to you and everybody else that's watching.
Okay, the reason I asked that is because I was wondering about, they got a thing on there saying that we can't use that for any kind of movies or anything like that. I saw a thing up on C-SPAN too, I believe. But anyways, I see that where does the big banks get their money? Are they getting it from the Fed, through the Fed for nothing? Because I see where on C-SPAN where Bernanke said that they were paying them 1.3% a day to leave the money in the Fed. In one of the hearings, that means that we're paying them to leave the money in there. That's why we're not getting it. The other thing is that I saw a thing on C-SPAN where Bank of America, when they had that credit card problem here about a year ago, they said that one of their spokesmen was screaming at somebody that was yelling at him, saying, "You misunderstand. We're not a bank. You still think we're a bank." That's what he said.
Professor Angel, I'll give you a chance to respond to a few things there.
Sure. Well, let me tell you where banks get their money from. They get most of their money from you as depositors. So the way banks make money is they borrow money from depositors like you and lend it out to other people at a higher interest rate. They also borrow from other people. They'll borrow from other banks. They'll borrow from corporations. You know, they'll borrow from anybody where they think they can borrow cheap. Now, they also got some money from their shareholders. You know, that's the initial investment in the bank. That's their equity, as we call it. But most of the money they get by borrowing it. Now, banks can also borrow from the Federal Reserve. Indeed, that's why the Federal Reserve was created, because banks borrow money from depositors and they lend it out and they put it into things like car loans, credit cards, mortgages, and whatnot. But the deal with the depositors is you can get your money back whenever you want it. And if all the depositors want their money back at the same time, what's the bank going to do? Go back to you and say, hey, Ned, you know that car loan you got from us? Why don't you pay me off right now, because I need the money. They can't do that. So because of that, the Fed was designed to be a lender of last resort. So if a bank needs money, they can borrow it from the Fed, but they're supposed to be a solvent bank that has good collateral to secure the loan.
Let's go to State College, Pennsylvania this morning. Gregory is on the Republican line. Good morning. You're on Washington Journal.
Thank you, gentlemen, for taking my call. To the professor, if I may, I hear the terms impunity and greed and crime and lack of regulation and other reflections on the co-relative LIBOR, which is British, and prime rate, which is American. I'm thinking to myself, there is such a thing, and there is a mechanism for dealing with it. I mean, we have people flooding into the United States for bonds, and the interest rates are zero. And we also have people out there with huge, huge fortunes. Now, where is the vision of our regulators that put this together and say, okay, these people that got this excessive, outrageous amounts of wealth owe it to our Treasury, and therefore debit, the wealth and credit the Treasury. That would put a balance or a cap on this thing. This whole thing reminds me of the Nazi officer in World War II who impersonated an American officer up until the time they shot him against the post. I mean, somebody's got to be seeing this at the top and for what it's worth. And it's $1 equals $1. The people that have it that don't or shouldn't have it should be accountable to our Treasury.
Well, the question you ask is, what is the vision of our regulators? Now, the problem is we've got hundreds of different financial regulatory agencies, and they all have very narrow mandates. Every time there's a problem, Congress comes up with another Band-Aid. They create another agency to do a narrow thing. So when the financial crisis was unfolding, people like Ben Bernanke were saying, oh, I don't have the authority to do what I want to do here. And that's the problem, that instead of having a grand vision, what we have is a very fragmented, archaic regulatory structure that was designed almost 100 years ago. And it may have been a great regulatory structure 100 years ago, but we seriously need to rethink it in the modern world.
We're at the second anniversary of the signing of the Dodd-Frank bill. Has that bill done anything to crack down on LIBOR manipulation, or could it have stopped this?
The problem is Dodd-Frank did so many things, and it added so much work to what the regulators are doing, that it may very well have slowed down their ability to deal with this scandal. Because there were some very good things in Dodd-Frank, but a lot of things were not well thought out. There were a lot of things that were thrown in at the last minute, like the so-called Volcker rule, and all the regulators are scratching their heads trying to deal with this mess that Congress dumped into their laps. And that in order to get the bill through, there were a lot of political deals at the last minute, and there were a lot of things that just were not well thought out.
What were the good parts about it?
Okay, well, the good parts about it were, for example, an orderly resolution authority. Now, I have a lot of issues about the details, but one of the things we discovered is that really there is no such thing as a too-big-to-fail institution, because big institutions do fail. And when they fail, we have to figure out how are we going to contain the damage. One of the problems in the last financial crisis is every time a large institution got into trouble, we got a different response from the government, and we could see they really hadn't planned for those events. So one of the good things in Dodd-Frank is they're thinking carefully about the so-called living wills, about what are we going to do when a big institution fails. Now, we try to prevent their failures, but there's no institution that is too big to fail, because sooner or later something bad is going to happen. And so we need to have contingency plans in place for when they fail.
In the few minutes we have left here today on the Washington Journal, we'll go to Dennis on the independent line from Dallas, Texas. You're on with Professor Angel.
Hi, Professor Angel. I heard you say earlier that the Federal Reserve Bank in New York was a linchpin or a mainstay of regulation in the market. I'd just like to say that when banks are put in control of the regulations of the financial industry, that's like putting the fox in charge of the chickens. I don't think that's a really good idea. My question to you is, where in the economy would we see the greatest negative impact of the LIBOR rate manipulation? I think it would be associated with the investments that our municipalities and other government organizations have on their books. What kind of impact do you think we're going to see from that LIBOR rate manipulation in these investments?
Well, I think the biggest impact is there's going to be a wave of litigation, and the attorneys are going to rack up huge fees, and this is going to be a diversion of resources away from much more productive activities. Now, you're right. Many of our states and cities have borrowed money, some of which is tied to the LIBOR rate. Now, during the financial crisis, it appears that LIBOR was manipulated down, so maybe they were paying too little during those years. At other times, it looks like the LIBOR may have been manipulated up. So it's too early to say, where's the financial damage, but clearly, there is going to be a wave of litigation involved here, and that will be I think that'll be the biggest immediate impact. And then the secondary impact is, what are we going to do about it? Now, we need intelligent regulation. We need to fix LIBOR. But will the fix be worse than what we have now? In other words, will the regulation be so cumbersome, so bureaucratic, so poorly thought out that we end up with a worse outcome than we have now? Clearly, we need better regulation. We need more intelligent regulation. We need faster regulation.